What happens when a firm sells an asset they no longer need? In this video, I will talk about how firms recognize gains or losses on sale of long-lived productive assets. Long-lived productive assets are assets that provide economic benefits to the firm over a long period and time. This is not inventory that the firm bought in order just to sell it, but rather these are the assets that are utilized in the operations of the company. These could be tangible assets, so assets that you could physically touch, and we might call them fixed asset, property, plant, and equipment, PP&E. They include everything from buildings to land to machinery, computers, etc. Or they could be intangible assets whose value is not in its physical substance, but rather in its contractual or artistic characteristics. And these include patents, copyrights, trademarks, etc. Now, the importance here is the intention. So you could have a company that buys furniture in order to sell it, and then it's inventory, or you could have a company that buys furniture in order to use it. In that case, it is a long-lived productive asset. So we're here talking about the assets that were acquired with the intent of usage. However, is it possible that a firm decides to sell it? Absolutely. Sometimes there are assets that have reached the end of the useful life to us, but they might still have value to someone else. Sometimes the firm might be pivoting and there are assets that were useful to them. They thought that they would use them longer, but they are no longer operating in the way that fits with the design of the business, that fits with the strategy. There's a variety of reasons why a firm may decide to sell its productive asset. And the question is, how does it impact their financial statements? The sale of the asset will impact both the balance sheet and the income statement. On the balance sheet, we will essentially remove the asset and any related contra asset accounts, such as accumulated depreciation, that are associated with that asset. The impact on the income statement is going to be determined by two things. Number one, what is the book value or the carrying value of the asset that we are removing? And number two, how does it compare to the net proceeds that we are receiving? In other words, what is the asset that we are giving up and what are the assets that we are receiving as compensation in this transaction? If we have the situation that the net proceeds that we are receiving are bigger than the book value that we're removing, then we have a gain on the sale. If we have a situation that the proceeds that we are receiving is smaller than the book value of the asset that we are removing, then we have a loss on the sale. Both gains and losses are going to be included on the income statement. And again, whether we have a gain or a loss really depends on whether we're able to get a good deal on the sale of the asset. Let's start with a simple example. Let's start with an example where it's not a sale, rather this is just junking of a tangible asset. So we have an asset, we no longer need it, but it is not at zero book value yet. Let's suppose that we have a laptop that originally cost $4,000. It has reached the end of its useful life to us, but we have not yet fully depreciated it. So the accumulated depreciation at the time that we decide that it is no longer useful is only $3,000. At the point in time that we decide to junk this laptop, the book value is $1,000. What are the proceeds that we're getting? In this transaction, the proceeds are zero. We're not getting anything. So we have an asset that we're removing from the books that's $1,000, and coming into the company is zero. It's nothing. So disposal of the laptop would trigger a recognition of a loss of $1,000. Specifically on the income statement, we would have a loss on disposal of $1,000. That depresses our profits. Don't forget that we have a mechanical relationship in the quarter where a transaction reduces our profits. Of course, it reduces the retained earnings as well. What's happening on the asset side of the balance sheet? We're going to remove the parent account. So the asset itself, which has been carried at cost, $4,000, let's call it property, plant, and equipment. At the point of junking of this asset, the value of the accumulated depreciation is $3,000. So we're going to reduce accumulated depreciation by $3,000. Notice that there is a plus sign on the effect of the accumulated depreciation here. That's because it is a contra asset account. So it sits in the asset side, but a reduction to contra assets increases the overall total assets. So we're going to fill it in our representation of financial statement template as an increase in total assets. And again, that makes sense if you remember from the prior videos when we recorded depreciation expense, that increased accumulated depreciation. We showed that as a negative effect on total assets. Here, we're getting rid of the parent account. We're getting rid of the child account. So we are reducing accumulated depreciation. We're doing that with a positive effect on total assets. So overall, this transaction would hit our income statement with a charge of $1,000, and it would reduce our net assets by $1,000 as well. Let's add a little bit of complexity. Let's say that instead of actually junking the asset, we are selling a tangible asset. Suppose a firm sells equipment for $5,000 in cash. And if you were careful, you saw on the slides that I had previously, I said net consideration. And that's because here we're really going to be focused on the money that the company is receiving minus any transaction fees. So for now, I'm going to simplify. I'm going to say this transaction was seamless. There were no frictions, so it didn't have any seller's fee or anything like that. They really do receive $5,000 in cash. Those are their net proceeds. Now, this particular tangible asset had an original cost of $10,000, and the accumulated depreciation at the time of the sale is $4,000. What is the impact of the sale? We need to calculate whether this transaction led to a gain or a loss. For this particular asset, the cash received is $5,000, so these are our proceeds. The book value is the original cost, $10,000, minus how much we have already recognized in depreciation to date. That's $4,000. So the book value is $6,000. So we are removing one asset. The net value of it is $6,000. We're receiving another asset, which is only worth $5,000. This is a loss transaction. Our proceeds are lower than the book value of the asset that we are removing. We're going to show this as an expense or a charge or a loss on the income statement. Notice that a language that I have here on the bottom line, if you watched my introductory videos, this language might be familiar to you. I am not writing it in a way to be confusing or intentionally deceitful. This is actually the very common language that you are likely to find on the financial statement. For a line item that could be a positive or negative, the label will typically contain a helpful hint for us in terms of whether this item is profit increasing or profit decreasing. The way that you want to read a label like this when you see it, if you see a positive number here, it's a gain. If you see a negative number here, it's a loss. Again, how do we know it was a loss? By comparing the proceeds that we're receiving to the book value of the asset that we are removing. For the same transaction, let's think about how it impacts the financial statements. On the income statement, we do have a loss on sale. So that's $1,000. I'm going to put it in our expense/loss column here. That decreases our profits by $1,000. Of course, that decreases the retained earnings by $1,000. What do we have happening on the asset side? Well, we are getting cash of $5,000. So that goes up. We are reducing the parent account. So the equipment, I could have called it PP&E, whatever this particular tangible asset is, it has been carried at cost. So the equipment goes down by $10,000. The accumulated depreciation, which is currently to date $4,000, is also going to go down. We're going to show that as an increase in total assets. Let's suppose the same asset was sold not for $5,000, but for $7,000. Now, in this situation, we are giving up an asset with a book value of 6, but we're getting proceeds that are higher than that. We're getting proceeds of 7. That would lead to a gain of $1,000. So here I'm going to put this in the gain column. I want to be very clear. I have this revenue/gains here on the income statement just because I don't have enough room to really spread it out. But the company would not be allowed to treat this as revenue. When you are selling a productive asset that you were using as part of your operations, that is not the same as selling your inventory. And again, here the intent matters. So if this is a company that doesn't normally sell equipment, instead this is an equipment that was a long-lived asset, it is an incidental transaction that they happen to sell it. we're not going to lump this together with their normal sales. We're going to show this separately on the income statement in a gain account, very clearly labeled. I'm just showing it on the revenue side because it happens to be a profit increasing item, just like revenues. So gain of $1,000, profit goes up, retained earnings are increased as a result of this transaction, of course. The cash goes up $7,000. Notice that for both of these transactions, regardless of whether you were able to sell this equipment for $5,000 or for $7,000, we have removed the accounts associated with this equipment in the same manner. For both of those situations, the cost, the parent account of tangible fixed assets, which has been carried at cost, has gone down by $10,000. For both of those, the accumulated depreciation, which captures how much of these $10,000 have already been expensed, that goes down by $4,000. Contra asset, so we're going to show it as a positive $4,000. Now, here is a question. Is one of these transactions ultimately better than another? Is it more desirable? Is it indicative of better management? And again, if you're watching my videos, you have probably taken hints before that typically these questions are not going to have a single answer. I cannot answer this question. So all this means is that in the first situation, the anticipated sale happened maybe earlier than expected. They did not recognize enough depreciation as anticipated. Their useful life was maybe not exactly correct in terms of the expectation of when the sale is going to occur, when the salvage value is going to come in. The first transaction just tells us that there was not enough depreciation recognized on this asset to date. So now we're catching up with that by recognizing a loss on the sale. For the second transaction, that tells us that maybe we recognized a little bit too much depreciation. The salvage value, the value for which we're able to sell this asset, it turns out to be higher than anticipated. Now we're making up for that with a gain. One is not inherently better than another. I think ideally, if the management has perfect foresight, if they can think ahead how long they're going to use the asset, when it stops being useful to them, what is going to be the salvage value at the time that they sell it, then we're not going to have any gains or losses because then they will have depreciated exactly enough where the book value at the time of the sale will exactly equal to what they're able to sell it for. But that is a really difficult ask to think ahead how long the assets will be useful for, what condition they will be in, for how much they will be sold at that point in time. So it is pretty normal to have gains and losses, which just represent that this estimation was not perfect. Let's take a look at an example of disclosure about disposal of tangible assets. Here we have Construction Partners Incorporated. This is from their 10-K for the fiscal year ending September 2024. They tell us in the normal course of business, we sell construction equipment for various reasons, including when the cost of maintaining the asset exceeds the cost of replacing it. And this is a great disclosure because it highlights that companies don't always sell the assets when they no longer need them. They have other more complicated reasons. Maybe the repairs and maintenance is too high. Maybe the insurance is too high. Maybe the efficiency is not high enough. For whatever reason, they decide that this is time to go forward with a replacement. The gain or loss on the sale of property, plant, and equipment reflects the difference between the carrying value at the date of disposal, carrying value, again, synonym for book value, and net consideration. Net consideration is the cash or other assets that you are receiving minus any fees that you had to pay for that transaction. This is their excerpt from their income statement. We see the revenues here, the cost of revenues, which is what they call cost of goods sold. We have the gross profit, some general operational expenses, and the gain on sale of property, plant, and equipment. One thing I wanted to highlight is that this company has decided to include the gains and losses from their sale of PP&E as part of their operating income. It is shown here as a separate line item, but you'll notice that it is before the subtotal for operating income. That's because they actually do that fairly routinely. I did pull up some of their earlier 10Ks, and this is just something that they normally have every single year. They will have gains or losses on these transactions. So they decide that the appropriate presentation is to include it in the calculation of operating income. Here's an example of an alternative presentation in terms of the structure of the income statement. This is from Empire State Realty Trust, which primarily deals with rental properties. They do also have disclosure that they occasionally have a gain or loss from the sale of properties that they decide no longer meet their criteria, etc. From their income statement, they have total revenues, and here I condensed a lot of operating expenses. So here they have total operating income, and then they get to other income, including financing charges such as interest income, interest expense, and gain on sale / disposition of properties. You'll notice that in the case of construction partners, the gain on sale of the property is included in the operating income. In the case of Empire State Realty Trust, it is presented below the operating income. This is discretionary, so companies do have ability to decide the appropriate presentation, and this will reflect more than anything the nature of the recurrence of the transaction, whether this is something that is expected to happen every single year, whether they think of it as part of their just kind of operational decision of running the business, or a more incidental one-off event that belongs a little bit lower on the income statement. It's just important for us as users of the financial statements to be aware that there is diversity in terms of the presentation, depending on the underlying economics of these transactions and how they fit into the specific firm. Now, let's talk about a sale of an intangible asset. And right off the bat, I will say that we don't actually see these nearly as often as we see sales of tangible assets. But it makes sense for us to discuss it just to kind of round off and finish our conversation, and specifically the topic on long-lived tangible and intangible assets. Let's suppose we have a situation where a patent was purchased for $60,000. It was held for 3 years. The total amortization expense at the time of the sale was $22,000. That has been recognized in terms of the costs that were transferred from being an asset on the balance sheet to being an expense on the income statement. And at that point in time, it is sold for $30,000. At the time of the sale, the book value, also known as the carrying value, is $60,000 minus $22,000. It's $38,000. Now, they're only getting $30,000, so the consideration is smaller than the book value. This is going to be recognized as a loss. In terms of the impact on the financial statements, this will be very similar to tangible items. This will be a loss in the income statement. We see that as a profit decreasing transaction. Our retained earnings are also decreased. On the asset side, we are getting $30,000 in cash, and the intangible assets are going down by $38,000. Here, I am assuming that this particular company follows the accounting methodology where the amortization reduces the intangible asset directly instead of accumulating in an accumulated amortization account. Both of those approaches are permitted. If instead this was a company that was following the accumulated amortization methodology, we would see intangible assets go down by $60,000 and accumulated amortization, just like we dealt with accumulated depreciation on the prior slides, would go down by $22,000. Now, importantly, this was an intangible asset that the company has bought from someone else. Let's suppose that we have a sale of an intangible asset that was developed internally. The firm spent $400,000 to develop a secret formula, and those R&D costs were expensed as incurred. The formula is sold for $2 million. If you are wondering why the $400,000 are expensed as incurred, why they're not capitalized, then do make sure to go back and watch my video on intangible assets, where I walk through the differences between expensing and capitalization and the requirements to expense the internally developed intangibles in the US GAAP system. And in that video, I also talk about some exceptions to those rules. So again, here, because the firm expensed the R&D cost, they didn't capitalize it, there is no asset. The book value of this particular secret formula is 0. And this is a big difference from the prior example where we purchased an intangible asset. That's why we were carrying it on the book at something that's bigger than 0. In this theoretical situation, the gain would be $2 million because the proceeds of $2 million minus the book value, which happens to be 0, would be entirely a gain. Again, this would not be revenues unless this is a company who is in the business of developing secret formulas, which would be different. This is a profit increasing transaction, increases retained earnings, increases cash as well. I do assume here that there is absolutely no capitalization. Again, if you go back to the video on intangible assets, you will see a brief discussion here that even for internally developed intangible assets, there is some opportunities to capitalize things, for example, such as legal costs. So here I'm kind of simplifying and I'm assuming that either that's zero or that's really immaterial. Now, in terms of actual disclosures, it's not as easy for me to find examples of sale of intangible assets very clearly disclosed in the 10Ks as compared to the tangible ones that I showed you before, because primarily, again, these are not nearly as frequent of an occurrence. Most companies, when they buy intangible assets, they really don't have a good salvage value. When they no longer useful, they're not able to be sold. When they internally develop them, again, it's less common for us to see them sold and explicitly labeled as gain or loss. But I do have a couple of examples here. One is a really good example of a company successfully flipping something. So they're not flipping a house, they're flipping a portfolio of brands here. B&G Foods in 2013 bought Pirate Brands, LLC. So they paid $195 million, majority of which was due to trademarks. These were very valuable. $152.8 million was allocated to trademarks. 5 years later, in 2018, B&G was able to sell this division, the Pirate Brands, to Hershey Company for $420 million in cash. And they do decompose, they tell us what it is exactly that they sold, what are the assets that they have transferred over to Hershey, and those include trademarks of $152.8 million. The reason trademarks did not change from period to period is because trademarks are treated as an indefinite life useful asset. You can continue to renew them, so you don't need to amortize them. So the gain on the sale of the assets here, and this is all of the assets, so not just the trademarks, but all of them, was $176 million. But you can see from the composition, most of the value in this particular business happens to be in trademarks. In terms of the financial statements, that gain would be on the income statement, of course, and on the balance sheet, they would remove all of the assets associated with Pirate Brands, and those unchanged trademarks of $152.8 million would go away. Here's another example, and I don't have the specific disclosure because this is a little more complicated. Kodak was in bankruptcy proceedings when they were going through this transaction, but we do have a punchline here. As part of the bankruptcy negotiations, Kodak sold their patent portfolio for $525 million. The book value of these patents is zero because all of the research and development costs associated with them were expensed over the prior decades. So this entire $525 million of proceeds can be thought of as a gain. During that particular quarter, we have bankruptcy negotiations, a number of other things going on at the same time. But if this was a normal situation where we would see the income statement of Kodak, we would see a gain of $525 million because the proceeds minus a carrying value of zero would net that. This was a brief introduction to the sale of long-lived productive assets, both tangible and intangible, and how companies recognize gains and losses depending on the money that they receive for that sale. I hope that you enjoyed this video. If you liked it, then please like, subscribe, leave me a comment, tell me what particular types of issues or areas I should tackle in the future videos. Please tell your colleagues and friends, anyone who you think will benefit from some more financial reporting knowledge, and I'll see you in the next one.